it's historic. It's a signal. It's a signal that Israel, I think, is concerned about the nuclear side and weaken Iran. This is historic, but it also shows the determination from the U.S. to avoid any sort of doubts with respect to the nuclear. So beyond that wild action, the other scenario is what's happening is, the dollar's been, dumped. It's gone from being a consensus long to a consensus short.
Hello and welcome to Soar Financially, a channel where we discuss the macro to understand the micro. My name is Kai Hoffman, I'm the EDGAR mining guy over on X, and of course, your host of this channel, and I'm really looking forward to welcoming back Diego Parrilla. He's the CIO or Chief Investment Officer over at Quadriga Asset Managers, and I'm looking forward to catching up with him. Lots has happened, especially over the weekend, of course, as you're aware. We've seen the US strike Iranian nuclear facilities, but we have to talk about today's market reaction. It's flat. Nothing's going on. Oil is up 0.6%. It was actually down intraday, while this morning actually was down a little bit and it was up 1.7% at the start of the morning. So really interesting market reaction. Gold flat, silver up by 0.2% as well, and the DXY is up. Bond yields are up by I don't even dare mention it. Barely up. So really, really muted market reaction. We'll have to talk about that and, of course, the overall macroeconomic picture. Lots of news coming over the summer here as well. July 9th is the end of the tariff, the tariff pause that ends July 9th. So we'll have to get something out of the US in terms of China and the EU in particular. So lots to discuss with my guest, but before I switch over, hit that like and subscribe button. It helps us out tremendously, and we appreciate it. Thank you so much for doing that. And now, Diego, it's great to have you back on the program. Really enjoyed our last conversation. It's good to see you again.
Thank you, likewise. Thanks for having me.
Yeah, absolutely. Lots going on, Diego. We have to make sense of the market reaction. Maybe we'll start there with our conversation here today, Diego. What do you make of the market reaction as it is Monday, 12:08 p.m. here in Europe?
Well, obviously what happened over the weekend is historic in the sense that to have the U.S. Directly intervening in Middle East again, especially in Iran, is major. At the same time, it shows in some ways. First of all, the market's been reacting to some of these challenges for a while now. But at the same time, it shows you the sort of effectiveness or surgical approach of the attack, very focused on the plan, which is the nuclear side. And to be honest, if you think things through, to some extent, if you look at the Iranian situation and the room for escalation, which is what would get the market truly nervous, there are reasons, perhaps for some, say, optimism in the sense that if you look at, first of all, the sort of reaction from Tehran, the estimates are they've used already half of the stockpiles. How much damage they've done. I think Israel is obviously extremely well prepared to fight back and contain some of those attacks. If you were a conspiracy theorist, you would argue that some of those missiles that come through, they may even consider that they led them through just to show, and justify some of the response. Of course, it's pretty harsh to make that argument, but I would say that Israel is in a position where they can contain pretty much everything that will come their way on a conventional manner. So I think in that sense, the damage so far has been minimum. The resources have gone down. The regional support, obviously with Saudi taking a dramatically different perspective in how they've opened up in the last few years, and the entire Shia-Sunni conflict, perhaps, the Arab world becoming a little bit less extreme, or at least the more extreme part less powerful. Russia itself having a direct war, where they have their own issues. Even the threat of newcomers like Turkey establishing stronger positions in Syria and other parts. It's a very complex dynamic, but I think overall, the bulk of the concerns seem to be related to oil and the threat of closing the Strait of Hormuz on the one hand, which, to be honest, also requires to some extent Oman and being on the other side. I think there's been, if I'm not mistaken, 15 threats of closing the Strait of Hormuz since 1980, and it's never happened. So it's really tricky to operational to get it done. Um, Iran itself needs the oil to go through to go to China and other places. So that threat, I think the oil market recognizes that it's relevant, but it's unlikely. Um, the estimates that are coming through from respected people like Goldman, are talking about different levels of which the disruption could take the oil price to maybe 90 or even 100 plus in highly sustained scenarios. But I think overall, the situation could result in some degree of terrorist attacks, maybe the weaker link, Iranian bases, sorry, U.S. bases, maybe in Iraq or other parts of the region, which could result in different levels of attack. But I think overall, at least with respect to the dynamic of the geopolitics, the main premium is definitely in the oil market, and it's losing some momentum. So yeah, we'll see. I think the market it's probably is not necessarily complacent about what's happening because it's historic, but I think it's being somewhat realistic about the extent to which Iran can actually either scale things up, or people in the region are willing or able to do that.
Yeah, it seems like the market has priced everything in already. So an oil price of $75 a barrel seems to be reflecting the current crisis accurately, it seems. I'm quite surprised that the reaction wasn't stronger in the market this morning, personally. But I think, I mentioned it to you before in the record button, but the role of China needs to be discussed as well. Just 20 minutes ago, I saw a post about the foreign minister speaking, and he says, "Well, the Gulf and surrounding waters are important international trade routes." It's a quote. So, and China gets about 80 to 90% of its oil from Iran. That's a huge number. So I think the political influence and will to close the Strait of Hormuz is not given, because Iran wouldn't survive financially either.
Yeah, precisely. I think they'd be shooting themselves in the foot. Their actual partners who are still able to support them would be hurt first. So, and the U.S. is actually long oil, both in terms of domestic as well as their ability to export. So, in some ways, I don't think that's going to be such a. It's not such a rational answer to the problem. I think they would be shooting themselves and their partners in the foot, and not creating any problem on the U.S.
No. If you were to categorize this event over the weekend, would you say it's rather noise or a signal for the market?
It's historic. It's a signal. It's a signal that um, Israel, I think, is concerned about the nuclear side. The rest, I think, it's under control. If you can uh, effectively deter and remove that, and weaken Iran, this is historic. But it also shows the determination from the U.S. to avoid any sort of doubts with respect to the nuclear. And it's a signal with respect to how the strength of the partners and the willingness of other parts in the region to come in. So I think it's a very, very strong signal. Geopolitics have always been here and are here to stay, but in some ways, some of the action, at least on the military side, is contained. What it means in other aspects of where wars will move, we've seen Ukraine, Russia being a good example, or the new ground of cyber attacks or whatever it is. I think again, it doesn't look like that this military side is going to engage into any real major event, given the large imbalance there. But geopolitics are certainly here to stay, and these are strong signals of many things. It's not noise.
No, 100% I agree. The question is, what does the market make out of it, and what is priced in, as we just discussed here. Maybe one last comment from my end. Russia says it deeply regrets and condemns U.S. strikes, but deeply regrets doesn't sound like, it sounds more like an oopsie than anything else. Doesn't sound, as you said, like the partners. I expect a stronger wording from China, Russia, and many others actually about those strikes, but they were fairly muted, in my opinion. So maybe one last question on that topic. Were you surprised that the reaction wasn't stronger?
No, I think, look, this has been a surgical attack on nuclear facilities and nuclear facilities that you would argue didn't exist, or they were not they were denied. So I think it's hard for anyone to justify the defense of that. Nobody, it's a very delicate issue, and we know the nuclear powers and what they can do. And I think preventing that is critical. So in some ways, whilst there are pros and cons, I think it'd be hard to stand so aggressively. So they will do so in ways in which it matters to them. The action for Russia is in Ukraine, the action for China is in Taiwan, and Iran it matters to them. Of course, they've deployed a lot of support in the past and reliance on the oil side, etc. But I don't think it's enough for them to scale up into a bigger major conflict. It's in their interest is more the stability. So I think the new chapter that will open up as well, I think is whether there's going to be internal opposition that emerges properly in Iran. I think these disruptions and this obvious weakness and what happens to the country, we'll see where it goes and whether it just falls by its own weight or it's been pushed out or and I think the lessons there are the presents are not great, but certainly in terms of a major change in the region is probably another front that is opening up for Iran itself, that it doesn't just need to worry about the outside world. I would suspect that there's going to be division internally as well. So I think in that sense we'll see where it goes, but a lot of open fronts, not a lot of resources, and yeah, they really need that oil flow and with those partners. So that's why I think the market's where it is.
No, perfect. Diego, really appreciate your opinion on that on that topic. Let's move back to the markets overall. Last we spoke was early March. I think March 6th or 7th we spoke, and you warned about a bubble forming and the bubble popping. The bubble actually did pop early April, at least for a short period of time. Maybe we have to recap a little bit. What happened and how did the market react? And did the bubble actually pop, or was just a little bit of air left out of that bubble and now it's reinflated? I'm really curious what your take on that is.
Well, first of all, we need to be very careful when we talk about bubbles. I generally define bubbles as every bubble has a misconception. So bubbles are artificial settings where basically you have a misconception that creates artificially high valuations. So if we're asking ourselves, there's a bubble, then what is the misconception, and what is the anti-bubble that resurfaces from that? And we could go through a lot of things. We could say, what valuations are artificially high, or Nvidia or whichever, or you could actually question, and we should go through it. What are the bubbles and what are the misconceptions? I think what's really obviously the entire tariff roller coaster. I think Trump has proven to be, a poker player, a businessman that looks it's a zero-sum game kind of guy. He's trying to gain from the other guys. Is less focused on win-win situations, such as trade. The approach in which, just the simplicity and this, the model he put forward, it was so weak in terms of, technical grounds, implementation. It was pretty obvious that the market would test him, and I think the real test, because they were ready, I think, for some pain on the equity markets, but the real test came from the treasury market. And what we witnessed during that period is a trifecta of weakness. We had U.S. fixed income collapsing, 10-year and 30-year yields much higher to levels that they start to be a problem in terms of the impact on just paying for that interest coverage, which is already over 1 trillion a year, and it's 50% of the budget deficit in the US. So with yields much higher, it starts to create a pretty huge problem. All that narrative of tariffs are revenue, quickly falls apart. So the collapse of, first, the treasury market is the real put. The second impact is the dollar, and third is the equity markets. We saw this synchronous collapse in equity, fixed income, so, and the dollar, which has in some ways woken up to a lot of people the reality of foreign exchange risk. Most European investors or others would be happy holding US equities, and when equities collapse, sometimes was due or came with the dollar strength. I mean, the double whammy of lower equities and lower dollar, and this the questions have been opened with respect to US exceptionalism and the tailwinds that are now turning into headwinds have, I think, put the key question into the forefront of the treasury market. I mean, is to what extent that's a bubble, and we have way too much debt, and the sustainability. I've written a lot about this. I talked about a lot about this. I think there are two clear scenarios. One where things get truly out of control, where yields start going, the bond vigilantes, push them to levels that require intervention in the form of yield curve control, and that effectively transforms a credit problem into an inflation problem through money printing and currency devaluation. That's the extreme scenarios, the emerging market like behavior of the US, which is what we witnessed. It happened to the UK in that Liz Truss moment, and why one of my newsletters was called the Donald Truss moment. We have that risk, which is now fading a little bit with fixed income being a little bit more stable, yields high, but not under pressure, and the U.S. sort of creatively finding ways for banks or other parts of the world to fund that gap. So beyond that wild action, the other scenario is what's happening is, the dollar has been, dumped. It's gone from being a consensus long to a consensus short. Positioning speculative is strongly against treasuries, and the dollar is open the question of whether both the dollar and treasuries are good defenders of the portfolio. My last newsletter argued, they're both down but not out, and watch out for shorts on either one, because I think under certain scenarios they will be strongly defenders, and what we're witnessing right now could be one of those scenarios. And yeah, as a result, of the action in the fixed income and dollar, equities in some ways have removed some of that premium, negative premium from the tariffs, but the uncertainty is still out. But you've seen in some ways the bluff and the bargaining, the belief of Trump in the tariffs being challenged. The entire taco thing, with people are realizing that Trump changes his mind very quickly. And some of the actions are being discounted. I think so. This volatility, the uncertainty is still there. The damage in some ways is already done, but it looks like as we go into these extensions, they're most likely going to be rolled in some ways. I think the weakness of the theory and the implementation is very obvious. And whilst there's still more to come and more uncertainty, and I think the path of inflation, uncertainty, economic weakness, and potentially volatility is damaging for markets. But to the extent that your question was focused on bubbles, I think we need to be very specific about exactly what bubbles are we talking about, what is the misconception, and is this going to be pricked, or is it going to be perpetuated and effectively transforming the problem, as I think is the case. When you face inflation, it's like the great philosopher Mike Tyson. Everybody has a plan with all these things, but then the market punches you in your face. So I think this is the path forward. Stagflation is certainly, in my view, the end game from a game theory perspective, and all the parts are trying to move to try to adjust to this reality. But yeah, it's a complex setup, and now we have this additional dimension, of heightened geopolitics. But yeah, overall, look, it's been a ride. My personal view is not over. Risk is open in both directions. Trend followers are being destroyed by these moves. Market down, volatility up. They're forced to liquidate and sell. They're now being reluctantly dragged into positions, being adding to longs up here, and who knows what's next. But I think it's a painful, difficult environment, whether you're fundamental or technical or momentum. It's been tricky, and yeah, I can see how the pain for the markets can be in both directions. We ourselves are positioned for difficult end of the year, and think the level and protection is actually very attractive. And so our strategies play, long the market with overlays and protection through options. And I think this is a good environment to accumulate that sort of position and embrace that volatility and try to be positioned for whatever happens, which I think could, it's a highly uncertain macro world out there right now.
Uncertainty, I think, is the key term here. Absolutely, Diego. You made some very excellent points, and I need to follow up with you on a couple. You already answered probably my next three questions with your last few sentences here as well. But on the tariff debate, you mentioned July 9th is the date the tariff pause comes to an end. It's been fairly quiet on that front. How much of a factor are the tariffs in the current market environment right now? What is priced in? What does the market expect? You mentioned the term rollover. Do you think those deadlines will just get extended because the Eye of Mordor is focused on something else right now? It needs to come back to the tariff discussion later when it has more time for it. Can you elaborate on that topic a little bit?
Yeah, look, I wrote about this earlier in the year, where I said, our tariffs, are they bluff, bargaining, or belief? And deep inside, I believe they're beliefs. So Trump generally thinks that the US, his goal, and I think Apple is probably the best example, right? Apple reacts to this situation by saying, look, okay, fine, you don't want me to bring stuff from China, then I'll produce it in India. And Trump goes kind of furious, saying, I didn't go through all this mess so that you stop producing in China to do it in India. I think it's pretty obvious that his message is not just about governments; it's to companies, where he's saying, you bring the production. And that carrot and stick, I think, is powerful, and he wants and needs momentum from the big guys. So he makes those announcements, of Taiwan manufacturing and many others. So I think he's really targeting the companies themselves. So I think that's not going away. He wants that, but he's also mindful that, or he should be, that some of these changes will require many, many years, many, many billions. And if you've built a beautiful factory in Mexico, you can just, switch off and on and produce somewhere else. So I think the reality, the belief is there, the direction is there, but he realizes it's, as a poker player, he's had to fold and use his cards. But the level of tariffs that are coming through, and he also needs a bad guy in this movie, I think in that sense, the situation with China surprises me a little bit, that it's been arguably the true bad guy from their perspective. You've seen this very goodwill, although the level of tariffs overall is high. They had to make some concessions because they would be really shooting themselves in the foot with some things like rare earths and others. So I think in that sense, the reality of tariffs is theirs. I believe it's been a bargaining tool, and I think the value of that bargaining tool is diminished. I think the quick wins with UK or others, I think they're easier, but it's a multilateral process, so tricky. And the bluff's been called, in some ways, and it's been called by reality, which is, the impact it's had in, as I said, first and foremost in the U.S. Treasury market and the dollar and the equity market. So I think they're there. The key word you mentioned is uncertainty. Uncertainty is bad for consumers. It's bad for businesses. People are adjusting their reality, and I think it will remain an issue for the foreseeable future, because it's a belief, and he has 4 years to go, and I think he believes this is a legacy item, right? So anyway, it's not going to be as much of a mover. I think some of these things might be, in my opinion, rolled over at much higher levels than we would have anticipated when it all started, but much lower than the peak. So I think the world's getting used to a new reality, and it's not so obvious either, how someone like China might be able to replace on a one-for-one basis what they lost, because, and I think that on paper puts Europe and others in a stronger position, but I doubt they will just open the gates to flooding of stuff. So I think it's a new era. Protectionism is there, but I think it's not going to be as aggressive and certain and volatile as the initial lineup, but it's here to stay, I think.
I have a quick follow-up, real quick, on that topic with the discussion with China, because in London we had some talks about 10 days ago that went really well, according to everybody, but then we've never heard anything from any results out of it. It was fairly quiet. There's some rumors about 55% tariffs, but it was all rumors, nothing really substantiated. Everybody flew back home to probably discuss with the leaders, but nothing came out of it. Like, how much uncertainty is coming out of that, and like, how do you the word is play that comes to mind, but how do you calculate that in your models? Like, how do you throw that in? Because that's a big piece of uncertainty in my book.
Yeah, it's it's uncertainty. You see kind of goodwill. I think China, in some ways, has been the adult in the room. It's been perhaps more pragmatic. I do think they have a weaker hand, but at the same time, they're not overplaying it either. I think they have stuff that they need and they want, and in some ways, I think the ego, high stakes. I think in some ways, in this particular case, even if China has arguably been the aggressor over the years, by effectively dumping and supporting stuff. I mean, all these things that they've been doing that are not really part of the fair game. I mean, if you want to have a world of open globalization, then you should play by the rules. And so whilst China in some ways you could argue has been the aggressor by not obeying these things and playing the game, game in the game, I think the recent price actions put the US more on that more aggressive front. And yeah, I think the ultimate agreements that they're coming to is, I can think of some examples in history, but dark episodes of history where even the worst enemies, Germany and the UK were actually doing deals. One needed if you read this wonderful book, A Material World, you hear about the rubber for the wheel, the truck wheels, and the other guy had the lenses, and they were trading in the middle of war, like, we were giving each other tools. So it's if you can get to an agreement in the middle of such a war where we both need something from the other side, then everything's possible. But yeah, I would say that's kind of the game. It's like, I think, some of this stuff is strategic on both sides, and they're able to get to these agreements, which is remarkable, and it shows some degree of pragmatism and perhaps common sense beyond the line that is set by Trump, which is sort of very, very volatile.
Yeah, perfect example. Russia offering to be the mediator between the US and Iran on the nuclear side, I think, is the perfect example for what you just mentioned as well. Like, where the biggest enemies are working together to achieve a common goal, right?
Yeah, absolutely.
So, really, really interesting. Diego, we have a couple more topics that we need to run through, unfortunately, a little bit. It's stagflation and inflation. They're intricately linked, of course. We talked about the oil price reaction and what is priced in. Stagflation. Let's break it down. All the big forecast, or I wouldn't say forecasting agencies, but OECD, IMF, World Bank, everybody said global growth is to slow down this year. The US is ignoring it. President Trump is being aggressive toward his Fed chair. What do you make of stagflation there? You used that earlier, that you're forecasting stagflation. Can you break that down for us? How will that be visible?
Well, first of all, I think when we talk about inflation, we need to understand its different components. And the first part is let's call it cyclical inflation. So you have the ups and downs of supply and demand, and high oil prices and lower oil prices, and recessions and whatever. The more important side of inflation, in my view, is monetary inflation. So it's about money printing. It's about excessive level of debt that needs to be, monetized, and that's a real inflation. The structural inflation is like the entropy of the universe. It only goes up, right? So I think sometimes we get fooled by deflationary pressures, and do not realize that central banks and governments use those deflationary pressures to even print more. So I think the game is designed to finish in stagflation. It's kind of the core argument of one of the key arguments of my book, The Anti-Bubbles. And every time we face a problem, be it a pandemic or a war or a credit crisis or regional banking crisis, whatever it is, we always do the same thing. We just print and borrow our way out. And that doesn't solve the problems. It delays, transforms, and enlarges them. And so I think in that sense, every deflationary pressure actually creates more of the wrong type of inflation. And when the level of debt is too high because you've abused the system and created, artificially high levels of debt that would not be able to be financed at normal rates, you create this dependency. So I think I have a strong view that stagflation, ultimately is what we see. You kind of scratching your head saying, how is it possible that the economy is not doing great, but housing prices keep going up? I mean, who can afford this? And I think there's a very naive way of understanding how things work. It's just a denominator effect. There's more euros, there's more money printed. There's the monopoly effect, right, of the board game. And so inflation is not so much as value of things go up, is the price of things go up because there's way more paper. And so I think that's really the key thing about inflation deflation debate, and what it means from a monetary perspective. Of course, central banks around the world have, in the case of the Fed, dual mandates for economic stability and employment, and it's kind of hard to justify the aggressive cuts in my view, given the financial conditions, where equity markets, where's employment, etc. And I think the Fed members have said it. They rather be late in the right direction than early in the wrong direction. And I think the threat of inflation, and I think this is interesting because ultimately, the long end of the curve, there's no question that, in my opinion, if it gets out of control, it can become reflexive, and it's a huge issue, and would certainly result in some sort of intervention through yield curve control or Operation Twist or whatever you want to call it. In that scenario, in some ways, whilst it looks bad for the US, and it is, it sort of puts the emphasis in the rest of the world. Look at Germany, look at Japan. I mean, they're in a similar, or in some cases worse situation, but they're doing it from yields at 2.5 and 1.5 in the 10-year. So to be honest, they haven't really taken a fraction of the pain that the US fixed income has. They have a fraction of the duration power to defend, and those hikes, whilst they would narrow the interest rate differentials, they also create problems on the credit side. So the second order effects of what we're witnessing on the Treasury and dollar is that if you don't have that chaos, if you manage to stabilize the thing, suddenly being short the dollar or short US duration or whatever starts to be pretty tricky, and being long, JGBs or bonds, it's definitely attractive in local currency, but you fight in steep carry. So that's why, as a contrarian, I think the dollar and duration are down but not out, and I think this is all back to inflation, monetary policy, portfolio construction, structural hedging. There's a lot of dynamics in the process, but I think from a super cyclical perspective, this game is designed to finish in stagflation, and I don't see how this changes easily, given just how the system is built. The political and monetary and structure of the market is just going to continue, and that's why, we're all frogs, in a monetary broth. All these fixed income investments, cash investments, they look sensible, like, okay, I'm going to reduce risk, I'm going to put my money here. The reality is we're being boiled to death by inflation, and it's not official inflation. Official inflation is total BS. It's the real inflation in the system, is the loss of purchase power, and why I think portfolios should be more risk on and protection, rather than more of a barbell with long equity and long protection and rebalancing, rather than this fixed income investments, particularly in markets where you have very low yielding currencies. I think the case for US duration is much more appealing, although it's there for the wrong reasons, and right reasons. So the right reason is the Fed was able to hike beyond levels that the other guys couldn't, so it's a sign of strength. But once you pass the point of no return, things require intervention. So it's a really fascinating sort of meta-stable equilibrium. But I think net, with everything that's happening right now, I think maybe the dollar and duration are looking a little bit better than they did a few weeks ago, and the narrative can change very, very fast, as we've seen. So inflation is and will continue to be at the epicenter of the action, and the problem is already done in the fixed income space, and why these things will have to be contained. But ultimately, I think the entire party across global markets has been financed by fixed income investors, and i.e. frogs in boiling water, and that's not going to disappear. I think in the foreseeable future is part of how this game is designed.
Diego, you've been dropping hints of what investors should do in the medium to long term moving forward and where they should potentially allocate. But maybe to summarize, because I know you like to use the euphemism of a soccer team, for example, for the defenders. What's your starting lineup? And you don't have to name all 11 players, by the way, but what's your starting lineup? Or what should our investors that watch this be? Like, what's the ideal starting lineup? Again, not financial advice or anything, but more, what's the ideal starting lineup here?
The first point people need to think about is what does diversification mean, right? And in particular, I think a lot of people fall in the trap of false diversification, which is confusing a portfolio with many things with a diversified portfolio. So let's say some of our listeners and viewers have 20 cryptocurrencies, right? You would say, look, I'm diversified because I have 20 cryptocurrencies. It doesn't take a genius to know that they're moving in parallel, right? And so you get this false diversification, right? The second point is this is a conditional game. It's about how do you perform not on average, but how do you perform under certain extremes. So if you look at March 2020 or other type of scenarios, you want to see how did I do in those specific points of stress. And the corollary of that is that a lot of people have teams with 11 strikers. You know, the obsession is how do I make money in capital and income? And the notion of defenders, where historically fixed income has played that role of defender, it's been challenged for all the reasons we've been discussing. The reliability of fixed income as a defender has been reduced, and there are scenarios where fixed income is actually part of the problem. It's not defending at all. It's playing for the other team, and this is why I think it makes sense to have more reliable goalkeepers. You know, assets that you don't just own out of fear. You own out of greed, in the sense that when this crisis happen and that conditional correlation and volatility, as the equities collapse, you get something that does very well. The whole point is that you're looking to monetize those to buy more strikers and vice versa. So I think it's about embracing the volatility of the market through what I call rebalancing alpha. It's not just about the value of the strikers and the defenders and goalkeepers as separate individuals. It's how do they play as a team, and that teamwork is critical. So I think you have to embrace that volatility. And I think when we build those teams, you're the coach, you decide the strategy, but just be mindful of when you build that team, that is aligned with your utility function. What are you trying to achieve in terms of what do you really value, whether it's in terms of capital appreciation or inflation or volatility or taxes or whatever it's important for you. I think you need to build those teams to maximize that utility. And very often, I think there's a big disconnect, between in the game. I'm a big fan of sports, and I think there's a lot of lessons to be learned. Every single sport or game you can think of, chess or tennis or football or Formula One or any other, is a game of offense and defense. I mean, the best players in the world, I mean, Roger Federer was an insanely good defender. I mean, fast, and same thing with Magnus Carlsen or anybody else. This is not just about spectacular, offensive game. It's about building the defense. And I think most portfolios fail there because we have this obsession with picking players that score goals, and ultimately the team can suffer. And if you add leverage to that, then it's lethal, because then you get destroyed. And I think things are dynamic. So I would, we have a strategy that people who are interested, they can reach out, and they're used strategies, so they're publicly available. It's not. But I think it makes sense to actually create these strategies that combine that, long only striker with the protection and the rebalancing. And that's sort of our contribution to the game is try to fall in love with the problem, not the solution, not the product. And as you fall in love with the problem, try to find ways in which we can generally help investors, not only what to buy, but also how much and when, which is where the real difficulty comes. And that's what differentiates the amateur and the professional is those dimensions, is being able to not only know what to buy, but the how much and the when, I think, are critical. And emotional considerations can be massive obstacles. And so creating structures that are easy to understand and hold, such as protected rebalanced equity, I think it's a step in the right direction to be able to, so that the students want to do what they need to do, which is the secret of success.
No, fantastic. Really appreciate that, Diego. And just one thing, you got to be careful not to have just one star player that ruins the whole team chemistry. We've seen that happen recently in certain teams as well, to where you have one star and it just doesn't work out. Diego, really, really appreciate the conversation. It was fantastic to catch up with you again. Where can we send our audience to find more of your work?
Well, feel free to reach out through LinkedIn or Twitter, X. We run, the anti-bubble report is a piece we produce every month. It's free and it has thoughts on the market. Separate to that, for those who are interested in our investment strategies, we have a separate report. So if they connect through LinkedIn and request to be added, we'll be happy to engage with the team and hope our work is of help as we're all trying to team up and do the best we possibly can.
Absolutely. Diego, really appreciate your time. It's great to see you. Hope to catch up with you after the summer because, as I said earlier, I think it's going to be quite tumultuous. So it'll be volatile and uncertain. So really appreciate it, Diego. Thank you so much for joining us. And everybody else, thank you so much for tuning in to Soar Financially. I hope you enjoyed this conversation with Diego Parrilla. Make sure to go check out the anti-bubble report. It's quite interesting. And I'm sure you enjoyed Diego's explanation of what is going on in the markets and how you should be putting your lineup together. Really, really interesting comments. Let us know down below what you think about it as well. We want to hear from you. And if you haven't done so, hit that like and subscribe button. It's a free way to support us, and we tremendously appreciate it. Thank you so much for tuning in. We'll be back with lots more. Take care out there.